and welcome. So
Okay.
I want to, hand it over to you, Scott. But I just wanted to, before we, get into your presentation, just put up our iPlanGroup disclaimer here. iPlanGroup is a passive administrator. We're here to help with your self-directed IRA, hold it, process your investments, things like that. But we're not here to endorse or recommend any investments or any firms, any companies whatsoever. So leave this disclaimer up here for just a moment so everyone can see it. Bottom line really here is, you have to do your own due diligence on any investment or company that you decide to work with. And this webinar is for educational purposes only. So with that being said, Scott, I will turn it over to you, and we can go ahead and get going.
All right. Thank you very much, Matthew. I'm going to go to the next slide here. The iPlanGroup putting this together. It is an educational opportunity to learn more about exactly what Matt said, tenants-in-common and triple net properties. It kind of all comes together, and I hope, and you can put your questions in the system there and bring them up, and we can answer them as we go. But I hope to answer those questions as we go, and in the next 20 minutes or so, 25 minutes, we get to the end, and you have had your time well spent. You've got answers to the things that you came to get. And again, if there's not something that we answer or we fail to answer, love to talk further. We can work through iPlanGroup or myself to get you those answers. And this will be recorded and available to you. Also, if you have any interest, I can send out, or Matt can send out, a copy of the PowerPoint itself. So it's all about education. But really, that's what we want to do is spend the time together and answer the questions. You see right there, often TIC or tenants-in-common investments are considered great options for self-directed IRA, and we'll talk about the why behind that. First off, I want to educate you. Just go over this very quickly. Joint tenancy versus tenants-in-common. Sometimes it's called tenancy-in-common, but I want to clarify that with you. Joint tenancy, which is not what we're talking about today, but I want to make sure you understand, is multiple owners, same thing, co-ownership in a single property. And there's 4 unities, they call them, of possession, interest, time, and title. To understand this, all owners have an equal right to possess that property. And they got the time, same interest, they have an equal interest, they got the right at the same time, and they all own the title together in that shared ownership. And there's rights to survivorship, meaning it does not go to their heirs, it goes to the partners that are involved here. So I think that picture is quite representative of what it is. Maybe 5 partners come in, they have equal shares, came in at the same time, equal interests in that property, whatever those interests are defined in the contract. If one dies or one gets out or one leaves, those 4 partners remain and they have an equal interest. If another one gets out, they have an equal interest. And then all the way down the line. And ultimately, if it's one partner left, then it's not a joint tenancy anymore. Then that partner would be able to, again, according to the contract, pass that property on to heirs or what have you. But that is what joint tenancy is. Now, the difference in tenants-in-common, it is concurrent ownership. Same thought there is your shared ownership in a property. And you can have up to 35 owners in a property, a tenant-in-common property. And that interest doesn't need to be in equal amounts, nor do you have to take ownership at the same time. And you can do whatever you want with that property as far as selling it. You can't put something in there, but you own it just like real estate or just like a security, and we'll talk about the difference there. But you own it, it's yours. You can sell it, you can move it, you can hand split it, you can pass it on to your heirs, what have you, and nobody else is getting that share. So we often refer to that as kind of a pizza by the slice, and you buy the slice that you want to do. Now, I'm talking about right into the tenants-in-common, but I want to go back and also talk about why we're talking about what we're talking about. So I don't want to get ahead of myself, but you came on here because there was a triple net lease that we talk about. What about a triple net lease that lends itself to this model? Before we do that, before we talk about the TIC ownership, a triple net lease is usually a high piece of quality real estate, institutional quality real estate, the kind that we deal with, the kind that are right there and lend themselves to this. And they, excuse me, triple net lease is the tenant paying all the expenses, and so you don't have those expenses to pay for as an owner of the property or landlord. They're paying maintenance, taxes, and insurance. And so that is an attractive thing to you as an investor. But a lot of times those pieces of property can't be purchased in their entirety by one investor because they're high quality real estate. It might be single tenant or multi-tenant buildings, and most average Joes don't have the opportunity to get into that. Well, now we go back to TIC ownership, and fractional ownership is another way to talk about that. The history on it is the same thing as back in the 1600s in England. The serfs that were working the property then had an opportunity to buy property. They couldn't buy what they could their own things, so and they bought a nice piece of property, and they worked to the land together, and they shared in those benefits. So TIC, tenants-in-common, came from the 1600s in England, and again, it allows them to purchase property that maybe they couldn't afford otherwise. In this case, it's institutional grade real estate. So when you talk about tenants-in-common, again, multiple owners. Why? Because you band together and you get an opportunity to own a very nice piece of real estate and share in that. And then on the triple net side, your tenant is paying most, if not all, of the expenses. Some ownership or some fractional ownership tax. Obviously, it's real estate or it's something else. Today, we're talking about true real estate. It's not as liquid as stocks, bonds, or mutual funds. That's plain and simple. We'll talk about how liquid it is and the exit strategies and what you can do, because those are very well scripted, and the opportunities there are very clear. But we'll talk about that. Some TIC properties assign co-owner usage rights, and others don't. So a timeshare, and often they're referred to as fractionals. Those timeshares can be tenants-in-common investments, and they give you usage rights. And other ones, like a Walgreens store down the street on the corner, you could be a tenant-in-common owner of a Walgreens, and you could own 10% or 5% or 50%. You don't have usage rights at that Walgreens. You just are an owner. They pay their bills. They send you a check every month, and it's hands off. Now, if it's in an IRA, they send the check goes to your IRA, and that is put it back into your IRA that way through your custodian. And again, some investments are tax-driven, and some are not. Are you hearing me okay?
Oh, yes, I can hear you great. Actually, and that brings up a question. I wanted to go back to, one of your previous slides, you said 10 to 35 individuals. Do you know the history on that and why that cap is there?
Well, back in 2002, the tenants-in-common kind of guidelines and rules from the government, they felt like, I don't know why they came up or settled on 35, but there is a cap there. Now, our experience in what we do and what we operate in, we'd like to keep that number lower. You know, the more you have to manage people working together. And so our average is 10 to 12, but the government does cap that at 35. I don't know how they came up with 35. But
okay.
And so if the owners, maybe there's 10 owners in a property, you could sell your piece to 3 different people or 4 different people, and if that still falls within the 35, maybe now then it goes to 13 or 14, you're good. But there's a time when on the record and on the contract you can't have more than 35 at a single time. Now, the triple net lease and kind of the hands-off institutional quality property, you do as an investor have a third party, and co-owners have a third party property manager. They don't take care of the building, they take care of the relationship between the tenant and you as owners. And they collect the rent, they prorate the rent, they send that to you. And you also have voting rights and other things as owners, interface with that property manager and that tenant. Well, you can imagine if you get up to 35 owners and people involved, that gets a little bit more complex. Now, these kind of properties are really hands-off. You are not, you know, dealing with them day to day and meeting with these other owners. Often, you'll know who the other owners are and you'll have a list of them, but you may, over the life of a 15 or 20-year lease, not even have to interact with those other owners. You own your piece. You have your vote. You're communicating with the property manager. If there is a need to get together and discuss owners on what to do or sell the property or add to it if you wanted, then there's conditions in the agreement that said yes, you can do that. And again, the agreements are, you know, all different, but usually there's a unanimous decision on major decisions and a majority decision on others that you have the right to participate in. So
okay.
I probably went.
Yeah, and just so our viewers are clear, when you say tenants in common and there's an agreement, can you talk a little bit about what's the documentation involved in this type of investment with fractionalized owners on the deed? And then also talk to us a little bit about the agreement so we have a better idea of what you're referring to there.
Sure. So it's a fee simple ownership with warranty deed. It's just like owning the house down the street or a rental property. You own a hard asset. You don't own a share in a property that is a stock or security. You own an undivided fractional interest with warranty deed. And we're just going to use it as an example because it's a great example of Walgreens down the street. So Walgreens down the street might have a $5 million building sitting there. Let's just say you own 5% or $250,000. That is your slice of the pizza. You get 5% of all the income prorated every month into your IRA. If you did have expenses, which you often, not the full net, the majority, if not all of the expenses, then you would also have a prorated share of those expenses. But that's why people like triple net with a nice national tenant, is because the tenant's taking care of it. They just don't want to own real estate. They want to lease real estate and put their money back into their businesses. And so that gives an opportunity for again, institutions often will invest in multiple buildings, and they might do it in a REIT or other securitized things. And your average Joe investor or any size investor, accredited or non-accredited, meaning you have self-worth requirements or net worth requirements, don't have to worry about that. This offers them an opportunity to own a share of that property. And a very consistent stated return over a long-term lease with options to renew. So that's what's nice, is people know exactly what their return rate is when they get in. There's increases every year. They get a check in the mail once a month. They don't have to go fix toilets and fix roofs. They have a warranty deed. And they have a co-agreement that they sign before, that's all prepared in a due diligence package and a turnkey opportunity, where they know who the other owners are, what their rights are, what their voting rights are, again, where they fit on the prorated scale of ownership. And often the thing just goes, and it goes for 15 or 20 years. Usually new construction buildings. We work with single-tenant buildings and single-tenant occupants. And the other nice thing, we'll talk about it in a minute, what for, is you have a corporate guarantee from the tenant that if that location doesn't go well and they need to close it, that they would guarantee rents until you have another tenant in the building. But I think let me get through this, and then I'm going to go to some slides, and then we'll talk about that more. But those are some of the things you look for in what type of building you're talking about. A Walgreens or a medical building. A Walgreens or a medical building might be fairly recession-proof because people still need pharmacy and people still need medical help even if the market goes down. So we'll talk about the types of properties that we talk about. But the benefits of TIC ownership real quick, little to no management responsibility. We talked about the other things, diversification, reducing risk, and the prepackaged due diligence to facilitate your selection process. People that are interested in an investment property in the IRA don't have to drive around with a realtor and go kick the tires on houses and figure out what they can and can't do with their self-directed IRA. We just talked about this. So prorated share of all those benefits and also any expenses, prorated share of appreciation, depreciation. Hopefully the properties are appreciating over time. And often they're tied to these things, and 1031 exchanges, which is a different investment. But the nice thing is you pick the dollar amount you want. You're not trying to go match the dollars you have to a property that may or may not be priced at that thing. You just buy the piece of pizza that you want to put into it. So as an investor, you want headaches maybe of a one type of an investment property. Some people are fine with that. It might not be that big a headache, and so they can do other types of properties in their IRA. But some people come to the point where they're just sick of the hands-on, and they want a monthly flowing check and a commercial grade nice property to bring in their income and go do with what they want there. I'm not going to step through this in any real detail with you right now, other than to say it compares, and you can put numbers to anything. I think that the big thing is here, you take a similar investment, one in a tenant-in-common nice property that's what we're talking about, and one maybe in a duplex or an investment property. The real difference here in income, if you look side to side, is these tenants-in-common. If it's the right property, and again, you need to look for what you want. You could buy a tenant-in-common property and put in a pizza place and a donut shop in 3 years and a bagel shop in another 3 years because they turn over so fast. Or you can get a nice national tenant in there for 20 and not mess with it. Usually that's what we're talking about, and the 100% occupancy compares to maybe a 90% occupancy in a rental multifamily rental situation. And so the difference in that the return rates are both the occupancy and then who's paying the expenses. So if you compare against that, those are the two primary things here. Now, the people we work with charge $25 a month to prorate your checks, send it to you, and send you your tax papers at the end of the year. So it's very affordable. $300 a year for somebody to be the liaison between you and your ownership interest and the tenant there. Why it makes sense. Why a triple net single tenant TIC makes sense. First of all, we talked about it, real estate is the most common self-directed IRA investment. The stock market this week makes me sick, and I've got money in the stock market. I'm not promoting this to say that's all you can do and the stock market's evil, but the stock market this week has been evil, and up and down and crazy. And so if you properly diversify, then real estate ought to be something on your radar, seriously considered. And so these type of properties, again, they'll come out. It's not a guess what you're going to get every month. It's not a guess what your return rate is. It's a contract between you and the tenant and the other owners about what you're going to get. The key things on an IRA, and this is why a triple net makes beautiful sense for an IRA, is a self-directed IRA. There's two things. There's disqualified parties and there's prohibited transactions. A disqualified party in an IRA, a self-directed IRA, is you to start. You cannot do anything with your IRA that benefits you individually or vice versa. So you can't do anything to benefit your IRA. Let's just put that into terms of a rental property. If you own a rental home and you go work on the toilet or the roof, and that home is owned in your IRA, you have just benefited your IRA by your sweat equity. That has violated your IRA. The IRS will be knocking on your door, and you have disqualified the entire property, and it will be taxed and penalized because you violated that. You cannot benefit yourself or your lineal family up and down. So your parents, your kids and their spouses cannot be involved, do anything there that would lead to, that would be a disqualification, and you can't do that. Now what's interesting is the IRA can deal with your brother and your brothers-in-law and sisters-in-law and cousins, but it won't, so you could rent to them. They could be your tenant, but you would have to show that they're getting equal or market value rents and that they're not getting any benefit. And if you can't show that, then again you're in trouble. So step back to a triple net lease with Walgreens or whoever. We work with some dialysis companies that are rock solid. You think about dialysis, kidney dialysis, that will not be affected by hopefully by a recession. People still need that. So again, you're looking at the type of thing. You look at that, and you can't go work on the toilet at Walgreens. You can't go maintain it. That's a hands-off. And so this is a protection for you to just stay away from the disqualified parties on that. The same thing with prohibited transactions. Actually, the prohibited transaction was what I was referring to. But the tenant is not a family member, and the prohibited transactions you have to stay away from. So hands-off. It's just a nice thing to say, hey, this is in my IRA and I can't mess with it. I can't get in trouble because it is hands-off. Go here. So things to consider as an investor. Triple net lease, great model for the right options there. New construction, modern buildings. A lot of these places, they'll go do the legwork, they'll do the traffic patterns, they'll go figure out exactly where they want, they'll figure out the growing areas of town. You need to figure out what type of property it is. If it's a Jiffy Lube, and that sell that way, then that building 15 or 20 years from now is still going to be a building that's car related. You're going to have a hole in the ground, and you're going to have some bays. So you're going to know that that your next tenant, if they, at the end of a lease, is going to be Jiffy Lube, or it's going to be somebody else that's going to go in there as a garage. What type of building is it? Is it single tenant? Is it a nice, does it have good curb appeal? Is it a destination place? Is it retail? A kidney dialysis center needs to be nicely located, but it doesn't have to be on the main retail strip. So all those things you look at. Great locations, fundamentally sound markets. Again, the strength of the tenant. Do they give a corporate guarantee? Are they recession-proof? What's the history of the company that's offering this to you? They're usually called sponsors, and they're either called an investment sponsor or a real estate sponsor. What's their history? What's their track record? Check their references. What are my exit options? We'll talk about that just in a minute. And then what are the opportunities behind the property? Now, Rockwell, that's who I work with. We do not leverage any of our properties. We are Rockwell debt-free properties. So the bank can't stand over the whole property and say, we're taking it back. Those are debt-free properties. You own your piece. You might leverage your piece and figure out collateral with if it is loaned against. But often, banks again would probably take collateral on a home to own a piece. They don't want to come in and take back a piece of the pizza. So really, that in our world, there's two different reasons for leverage and debt. Leverage is good, and you can use other people's money to make money, but also leverage can be in the wrong time in the wrong place, like 2008. It can put the property upside down and somebody can come take it back. So you need to figure that out. We have never had an issue because we don't have debt on the properties. Exit strategies, like you say, it's like selling a piece of real estate. What's nice is most agreements have a first right of refusal in them, so the other owners in the building, if you choose to get out, they have the first right to buy you out. Usually it's not that big of a negotiated price because the cap rate is already established, and so is the monthly income. So you kind of know. I mean, you could negotiate if you wanted to, but you really know based on secondary markets and what things are trading at, what your document is, the value of your shares at that time. They're not going in and appraising the brick and mortar. It's an income property, and income properties are appraised by the income and the cap rates. So that's nice, actually, unless unless you want to try something different. You can put any price tag you want because it's yours. But they get the first right to buy you out. And then if they don't buy you out, folks like our company and others, there's a kind of a secondary market out there. And you can go to the property manager, and if they're managing other properties and working with other investors, they can throw that out there to them, and they can do that. We have a variety of properties we've sold over a decade, and we'll put that piece that's for sale, we'll offer that out to 400 plus investors and see if they want to do that. That's not in a contract, and it's just to the people that are, or a tick or a normal real estate broker. So there's ways to get in, but most people, understand this please, most people are getting into these because they want long-term asset protection. If you want to double your money and flip houses and whatever with your IRA, this is not the investment. If you worked hard and long and you hate the volatility in the stock market, or you're sick of managing properties and you want to be passive and you want a consistent, good, solid, competitive return on a great property with as much risk taken out as possible, then these are the type of properties that you can look at and lean on and be interested in. This is what I talked about in 2002. Key points there, and they apply both to a 1031 exchange, which is a tax-deferred exchange on ownership of property. They put a limit on the number of co-owners. Again, I don't know why 35. Voting rights for each co-owner, leasing agreements, and proceeds of the sale shared proportionally. I do want you to understand this, because people will talk to you about that and you'll find out about it. But again, there are security kicks and there's real estate kicks. Securities marketed through a network of broker-dealers, stockbrokers, registered reps. They can't pay a referral fee to anybody but somebody that's licensed securities broker. They actually pool funds and buy the properties and then they retain the property management of that, and they work that way, and then they pay you a return on your shares of that. Now, it might be one property, multiple properties, a real estate investment trust, a DST, what have you. A real estate TIC can be marketed through real estate professionals, CPAs, and other professionals. They can pay commissions to those commissions. One thing is they don't pool funds and then buy something. And they also don't retain property management. Third-party property manager manages, and they have no collateral against that property. So like Rockwell, we just buy a pizza. We make it available in smaller slices, whatever slice you want, to the investors that want a smaller share of the pie. Those investors band together as co-owners in a TIC agreement with title to their individual piece, and they work with the third-party property manager over the life of the property. Words of wisdom as we close. One more slide and we're done, and we'll open it up to whatever. As you look at these alternative assets, and that's what we talk about in a self-directed IRA, just be vigilant and responsible to know the process and procedure. Again, I think if you've got a good administrator and good custodian like iPlanGroup, they can help walk that through, but they have to remain neutral. They know the process, the procedure. They know who's disqualified and not, but you, it falls to you. That's why it's self-directed. The government's looking for you to make those decisions. Beware of those prohibited transactions. Understand those. Beware of disqualified or actions with disqualified people that could turn ups down. And then just reputable advisors, CPAs, attorneys, and whoever that understand the self-directed IRA. It's a great thing. Self-directed IRA, people can invest in what they invest in, and they are not beholden to the Wall Street. It's a great way to, again, protect assets, protect where you've been, and put your diversified funds into a variety of things to hopefully weather the storm in this crazy world and crazy markets right now. That's it. I'd love to take any questions you have, or I'll offer again this slideshow or the video to anybody who would like it, or those that didn't come today and that had signed up. I'll turn it back to Matt for questions also.
Okay, great. Thanks, Scott. That was a lot of excellent information there. So yeah, folks, if you have any questions, go ahead and type it into the questions box there. I will read them to Scott, and he can answer them. You know, I do have one question for you, Scott. You know, you mentioned a lot about doing due diligence, and we at iPlan think that's a very important thing as well. What can you tell us, you know, about companies that are out there if they're offering this type of investment? You know, how should they be registered? What are some of the things that the individuals on today's call should look for in regards to, you know, companies out there soliciting funds? How should they be registered, things like that?
Well, okay, so the two forms of ownership obviously are very different. So if you are considering, and there are good investments on both sides of the aisle for sure, so if you are considering a securities TIC, I would be asking about that. Ask them if it's a real estate or security. If it's a security, that will be a different avenue, and they have to have broker-dealer licenses, and they have to go through that and provide you that, and you need to understand that that's it. A lot of them will require that you investor, and to really understand that versus a non-accredited. Accredited investor really says it's the government's assistance, I guess, to investors to protect the smaller guys. They say if your net worth is over $1 million, and that doesn't count your house or your loan against your house, you have to take your mortgage and your house out of that. So if you have a net worth of $1 million or more without that, and or you've made $200,000 over the last 2 years and going on, it looks to be the third year, or $300,000 as spouses combined, then you can be an accredited investor. And they say an accredited investor should be astute enough to do a lot of their homework themselves. And so a lot of folks will only sell to accredited investors, where the non-accredited, or the guy that doesn't have that kind of net worth, can't get into those type of properties. So you need to ask that on the securities side. You know, what's required? Do I have to be accredited or non-accredited? And can I get in anyway? On the real estate side, you really just have to look at the firm, the history, ask them for references. How long have they been in business? Who do they work for? If they'll give you the financials or provide that, depending on if they're private or public. A lot of them, well, a lot of private companies, no matter who they are, don't share their financials. But again, you're not investing in that company, but they are a partner in bringing you to a good investment. So you need to understand who they are, what they've done, and ask the right questions. And if they're open to giving you all kinds of referrals and letting you talk to people that have had that experience with them. Also, internet research and other things on the company. What's their business rating? So real estate really is different than the securities, but they're both valid and good options.
Excellent. So it sounds like when doing, multiple person ownership in a property, it's not necessarily selling a security. Am I hearing that right?
No, on the real estate side, it's a hard asset. So just so everybody understands, you're not buying a piece of real estate investment trust is usually a fund, a security fund that goes out, pulls everybody's investors, multiple property. You might not even know which properties are in there. Hundreds of properties could be in there, and they're all paying their rent back into the fund, and they're managing the fund and taking out their salaries and all the expenses of the fund, and then they're kicking you back your return. But it's a more of a kind of a stock market return. How that fund does is how you get paid out. Where this is a hard asset, you own it. It's part of one building, each ownership, and you know exactly what the rents are. You get your scale. Now, can you eliminate all risk and everything? No, but somebody like a real estate sponsor or whoever should take every step to eliminate as much as possible. The flip side is risk and return. So if you're looking for a great return, you have to take more risk. If you're looking for less, settles down, but it's consistent, it's solid, and it's reliable.
Okay, excellent. Thank you for that. Let's see here. We do have a couple of questions. Let's see. One individual wants to know, Susan wants to know if we can get a copy of her slides. Are you willing to just or be able to download them? Okay, no problem. I know we're going to be sending out a brochure as well, your brochure via email.
Yep.
So we've got one question here. Just need to know if a triple net family residential, not in an, what would you say there?
Well, yes, it can. Triple net could be done anywhere if the tenant wants. Now, it sounds a little confusing. So let's not get the tick and the triple net confused. But a triple net means that the landlord pays the expenses. So the rent is received net of any expenses that the tenant might pay. So the triple net is referring to maintenance, taxes, and insurance. There's also absolute net, and I don't want to get confused there, but absolute net might include roof repair after 20 years, or any any structural repair, and the properties we deal with cover all of that. But those are things to ask, but really they often refer to it as triple net. So yeah, you can get into a single family rental if you consider they're paying the maintenance, insurance, and taxes on the rental property, and you're just collecting a monthly check, and they have to fix the toilet themselves. Now you can also do a TIC and get multiple owners in that same property and own your piece of the pie. You can set it up in a tenants-in-common ownership model also.
Okay, so it sounds like triple net is more geared towards the large properties, commercial, things like that, where they're handling everything.
You're right.
But in its essence, this is it's a multiple partners coming together to purchase real estate. And yes, you can obviously do that with a single family residence as well. It's just a little bit more different, management structure. I think in most single family investments, you're either managing it yourself or you have a property manager, and then you as the owners are responsible for fixing things. So definitely a little bit different structure. So we have one question here. I already have an investment in my self-directed IRA at iPlan, but the income from that investment just sits at iPlan gathering dust. What strategies are there available at iPlanGroup for reinvesting that income? I'm not retired and won't be for a while, so need that income to compound. Well, first and foremost, I'd say check out our YouTube page. We are constantly updating that with webinars like we're doing tonight. So there's all types of ideas out there on things that you can do. There's private lending where IRAs can invest and lend out to other investors, make a great rate of return there. There's tax lien investments. You can go out and buy your own rental property. So we're going to be doing some webinars with some of the turnkey providers out there. We're doing one here with Scott tonight. There's all types of different investments. Keep in mind you can still invest into traditional securities, stocks, bonds, mutual funds, and annuities, and things like that. We won't advise you, but the option is there for you. Now, obviously, with the market being what it is, people are looking for more non-traditional things, but all types of strategies, gold and silver. And this whole year, we're going to be rolling out at least one webinar, hopefully multiple webinars each month on different investment strategies. Okay, so things like gold and silver, precious metals, investment properties and rentals, things like that. We just did one last month on private lending. So stay in touch with us, and there's plenty of different options out there for you to reinvest. And you can obviously give our office a call if you have questions on a specific investment. All right, let's see. One person wanted to know if there were any tax write-offs in this type of investment. I imagine that management fee would be one, right, if they invested with personal money?
Well, my understanding, and I could be, I'm not a CPA and I'm not a financial advisor, but one thing I want you to know is if you're in real estate, in your IRA, the IRA is already giving you the tax-deferred or tax-free treatment of your money, and so you can't, in the IRA, you can't depreciate the real like you would and then recapture that when you pay your taxes and whatever. It's a separate. So you just need to understand that it is a smart investment, but it's a different type of investment where you're not getting a double dip. You're not getting the tax benefits of depreciation and also, the IRA growth and not having to pay for it or deferral. I think you understand that within your self-directed IRA, you can have a Roth. You can do a traditional where it's tax deferred or tax free, but you can't take those two. I don't know, Matthew, do you have any more on that?
Yeah, I think that's a great point to bring up, to differentiate between the personal money and IRA money. If it's personal money, like Scott said, talk to your CPA, see if there's any deductions there. I imagine if there's any expenses or management fees that an investment like this has, you probably can deduct that, but check that, check with your CPA. Now, but Scott brings up a really good point with this. If it's IRA money that's being invested, there's no deductions because there's no need for deductions. You're not paying any taxes on your profits when they come back to the IRA anyway. So there's no reason to deduct anything. So we've got some questions here. What are the rules if you want to transfer or your deferred comp or drop money so you can avoid penalties? If you have a deferred comp or some sort of pension, that can definitely be rolled over, especially if it's with a previous employee or employer. So give us a call at iPlan, 855-604-7526, and we can walk you through the direct rollover process for moving some money like that over to a self-directed IRA. Next question here, what is the relationship of iPlan and Rockwell? Are they one and the same or two independent companies? We are two independent companies, so there is no relationship other than we just like to work with great companies in regards to education for our clients. So we are definitely two independent companies. Again, iPlan is a passive self-directed IRA administrator. We're here to hold your retirement plans and act on your wishes or your what you want to do with the money. You're going to tell us. We don't advise. Here's another one for you, Scott. What would be a minimum investment, term of length? Are there SEC rules for a sophisticated investor? So I think you did cover that part for the sophisticated investor part. You can go into it further, but you did discuss, if somebody is accredited data or not. Is there a minimum investment or a term of length?
We have a minimum investment. Usually they do. Usually a sponsor will. Often in a security side, well, our side, because you're trying to because you're capped at the number of investors per property, but we have a $100,000 minimum. So it's not for everybody that got a $10,000 IRA that they're looking for something to put it in. It's not, but it's for any investor that has $100,000 or more to put in. You don't have to be accredited. Our average is about $400,000 or $500,000 because of the 1031 exchanges, which aren't IRA, and we brought that minimum down because of the IRA investors. So most people have that of some sort or fashion there, and then, like you said, the other alternative investments, if you have less than that, or if you're getting income from a rental property that's coming and sitting in your IRA and you're wondering what to do with it, there's other options there, but they each have their own rules.
Excellent, great, thanks, Scott. Okay, so last question here, will this presentation be available at the website listed? Absolutely. Not only are we going to send out a link for a replay for everyone on the call, but we also will post it on our website and our YouTube page, so it will be available to view again. So that's it, Scott. We went through all the questions. Great presentation again. Thanks for being on tonight. If there's anything you'd like to say to the folks before we sign off, I'll leave it to you. But again, thanks for coming on. Great presentation.
Thank you. And no, I don't have anything more to say other than all the best to everybody this new year, and may we all ride the crazy ride together and be smart in what we can do with our investments and look at the right options for us. So thank you very much, and have a great evening.
Okay. Thanks for being on the call.
Okay. Good night.